Rates live with the mortgage calculator. We will get started in just a few minutes. We're going to go over some live rates today, and we'll do a deep dive into a great topic here today. But let's wait a few minutes here to get started. Let us go live on all the platforms. We are streaming this live on YouTube, Facebook, and LinkedIn. So give us just a minute to go live everywhere, and we will get started. In the meantime, we did put the chat up on the screen. Feel free to drop your comments there. I see there were already a couple people dropping comments early. Owen, Raul, Warren, appreciate you tuning in early. And we'll get started here in just a minute. Hope everyone had a great week so far. All the loan officers tuning in. Hope you're ready to put some work in over the weekend. Definitely a great time to make calls. Thank you for the comments, Adam and Dario. We appreciate you tuning in early and commenting. We'll get started here in just a minute. As we go through here today, especially when we do our deep dive topic, feel free to keep dropping comments and drop any questions in there that you have. Thank you for the comments, Jason and Jose. Appreciate it. And it looks like we are live on all the different platforms, so we can go ahead and get it started here. We'll take the chat off the screen, but keep dropping comments in there and drop any questions you have as we go through. Welcome, everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a correspondent lender that specializes in non-QM loans. And we do this show every day where we pull up some live mortgage rates for different programs, and then we do a deep dive into a different topic. Now, today's topic is definitely something we're familiar with here at the Mortgage Calculator, since we specialize in non-QM loans and loans for our investors, which is going to be ground up construction. So not something that everybody offers, but we definitely specialize in this at the Mortgage Calculator. So our sales manager, Jose Gonzalez, with 28 years of experience, is going to pull up some different scenarios and do a deep dive into ground construction loans. But before we do that, we'll do what we do every morning, which is pull up our live pricing tool and go through the actual mortgage rates for a few different programs. So Nick, let's pull up the pricing tool and see what the market is looking like this morning.
All right, let me switch my screen and check it out. So this is our pricing tool, as Kyle explained. This will show us the general rates and the APR for today. It is August 25th, just after 11 a.m. Just had a big Fed announcement, so we're probably going to see some craziness here in the next hour or so. But this will show us the rates for right now. We have our general programs live. If you'd like a full loan estimate with all of the fees itemized and broken down, please get with one of our team members. We have over 300 loan officers in 24 states. And we can do our ground up construction, DSCR business purpose loans in 44 states. So a little bit wider footprint there. For all of our demos today, we'll set up the same scenario so we can compare APRs across the program. So as we do every day, we'll set up 400,000 loan amount. We'll set an LTV of 80% loan to value, 20% down payment. We'll set a desired price of 99. That means we'll ask the computer to find the best rate at one discount point in cost. And we will compare the different programs. We'll start with conforming conventional. Then we'll check out FHA, which is usually the next best option. Then we'll go into expanded guidelines, also known as non-QM, where we have over 5,000 additional programs using alternative income. We also offer VA and USDA. However, VA is only for our eligible vets and active service members. If you are eligible, let us know. We'll quote it, no problem. And USDA is only for eligible properties. If you do happen to be shopping in a USDA eligible area, let us know and we can quote it, no problem. Start today with conforming. We'll set up all the scenarios as purchase, 30-year fixed, primary occupancy, single family home, 1 unit, state of Florida, county of Miami-Dade. And for all the demos, we use an estimated FICO of 760 and an estimated debt to income ratio of 40. So with these settings, let's check out the rates this morning. It's about the same as it was yesterday, so no craziness yet. 7.375 rate, 0.875 discount points in cost, puts our final APR at 7.538. So a little bit lower than it was at the peak just a few days ago, but definitely hope that it comes down here. Now, if for any reason our customer doesn't qualify for conforming, typically the next option we would look at, set up the same scenario, is an FHA program. So everything else will stay exactly the same. FHA does allow a little more leniency on credit events as well as a higher debt to income ratio, but we'll keep everything exactly the same so we can compare across the programs. And this is still about the same as it was yesterday as well. 6.625 rate, 0.875 discount points and costs, final APR 7.213. So in this case, if our customer qualifies for both, conventional is a touch cheaper in this example. FHA is a touch cheaper than conventional in this example. So if our customer qualifies for both, definitely don't forget about FHA. And for our customers that must use FHA, this APR does include the upfront mortgage insurance and yearly mortgage insurance. So it's definitely a welcome change that they did a few months back. Now, where we really specialize is if our customer doesn't qualify for either program. Many other banks or lenders don't have other options, but we specialize here at the Mortgage Calculator in our expanded guidelines, also known as non-QM programs, where we can use alternative income. So we'll set everything else the same. However, we have a new option pop up now with non-QM where we can change our income. So full docs, what we use for FHA and conventional, that's 2 years of tax returns. So we typically choose this option so we can take advantage of one of these others, like asset related, business bank statement, our investor programs for investment properties, we'll talk about in a minute. Personal bank statement 12-month is what we use for our demo. We have RSU, stated, VOE, 1099, P&L, CDFI, no ratio. But the most popular one by far is the 12-month bank statement program. Most borrowers also know that this does exist, so very popular program. This is for our self-employed borrowers. Many times our self-employed borrowers, when they try to go full doc with tax returns, have different write-offs and may not qualify at all or may not quite get as much income as they really want. So in this case, we'll solve the problem for our borrowers by using just their bank statements, their last 12 bank statements, no tax returns involved at all, to determine a debt to income ratio of 40% in this case, using just their bank statements, just the cash in the bank. Typically, our self-employed borrowers will qualify for much more income, double, triple the income using this method, and can therefore get the home they really want. So these non-QM programs are great solutions, especially for our borrowers that need a little extra help. Ooh, and it went down a touch here again today. Second day this week, or third day this week, I think, where we have a non-QM 7.375 rate, 2.5 discount points of cost. Non-QM does cost more, but our final APR here of 7.492 is actually a touch lower than conventional. So not very often that we have non-QM programs lower than conventional, but today is one of those days. We also have tons of other options of more standard programs here. Some of these may allow a little more flexibility on things like credit events, such as foreclosures and bankruptcies. So not only can we get around the income issue, but using any of these dozens and hundreds of programs, we can get around other issues as well that would otherwise qualify or cause our customer to not qualify. Now, before we go into Jose's detailed example, we always want to set up a scenario for our investors. So we'll do our last two live demos for investment properties as we do every day. So whether you're a first-time investor or a seasoned investor, we have some good options here. We'll set up the same scenario, and we'll compare our conforming conventional to our non-QM options. Remember, government programs do not work for investment properties, so no FHA, no VA, and no USDA options. So we'll start with conforming conventional. Everything else is staying the same as all our other demos. All we've edited here is the occupancy, so we can see the adjustments that the conventional programs have added for an investment property. So just like yesterday, this is really not feasible, but again, we're doing it for demo purposes. So 7.625 rate for 4.625 discount points and costs. That's probably not compliant and not feasible, so we wouldn't even offer that to our client. But for demo purposes, it puts our APR at 7.912 in this example. Oh, actually, this is a little bit lower here. 7.5, but with way too many discount points. That's why it's coming up lower here. Both of these options wouldn't be feasible to sell to our borrowers, right? 4.625 discount points in the example, $18,500. Not only is it not feasible, but most borrowers wouldn't want to pay that much money in points. So unfortunately, conventional is really not feasible at the moment. We can also go up to 85 LTV. That's really not going to be feasible. 80 is not even feasible today. So we solve that problem for our borrowers with our non-QM options. So for the final demo, we'll set up the same scenario, and this time hopefully we find some reasonable costs. So we'll set up expanded guidelines, non-QM, and the first thing we need to select for that is our income option here. For investment properties, the most popular option by far, DSCR. That's because it doesn't require any income or employment. Simply use the estimated rental income from the property to determine a DSCR, debt service coverage ratio is what that stands for. If the estimated rents can cover the PITIA of the mortgage, the expenses, aka the property cash flows monthly, that's a ratio of 1.00 or higher. We also have options for properties that do not cash flow monthly, aka the ratio is under 1.00. For the demo, as we do every day, I put 1.5. That's the highest value we have so that we can see all the different options pop up. And prepayment penalty is standard on a non-QM investment property. So we always choose 3 years as the standard so we can see the most programs. There are some options for 0 that will limit the loan programs and cost more. And there are a few options for 5 years, which will save us some money, but not all loan programs allow it. So 3 years is standard. That way we can see the most options. So let's check out the DSCR rates today. Boom. Smoking option at the top again. Jose, second day in a row. We're beating conventional. So 7.75 rate, 0.85 discount points and cost. Our investors happy here. $3,400, a lot different than almost $20,000 in the other example. And the final APR 7.812. We are beating conventional with DSCR today. Second day in history where DSCR is going to beat conventional. So absolutely amazing. We love these programs. Our investors love these programs. Definitely recommend. If you're out there shopping, this is going to be the way to go for multiple reasons. We have other options here. If you scroll down, there's other options at a little bit higher rates and costs. Some of these may allow bankruptcies, foreclosures, things like we talked about before. And very popular request, some of these DSCR options may allow short-term rental income to be used. Of course, these would be the ones at a little bit higher rates and APRs, but allows our investors to purchase Airbnb type of properties. So very popular request. Now, let me go ahead and switch my screen and we'll get into Jose's example here, which is a very unique topic. Not many other banks or lenders offer these programs either. So we specialize in, the specialty stuff. So ground up construction is for our investors out there to basically build houses. So not a fix and flip. This is beyond the fix and flip, right, Jose? This is full vertical construction, in other words. So I'm not sure which examples you have, Jose, so I'll let you go ahead and take over and explain a couple different options that you put together.
Okay, good morning, everybody. Exciting news, Nick. I got goosebumps when you mentioned DSCR because we at the Mortgage Calculator are perfectly positioned to allow our investors to take full advantage of the economies of scale that we have created over the last 4 years, as that was a big objective in our business plan. Was the investor focused loans. We just did not get into DSCR now that agency was tanking. That was part of our business plan from the inception, which is why we have so many options and which is why we have trained our MLO team so well to be amazing consultants, which is why we get so many investors coming to us with portfolio loans looking to refi all of their properties out of a portfolio loan into individual loans, cash them out, and buy more properties to take advantage of the great rental rates out there. So getting into ground up construction, excuse me, what I wanted to state first of all is that ground up construction, do not confuse that with one-time close programs, right? A one-time close program is for primary, or if you're doing conventional, second homes, right? We can do one-time close, conventional, VA, FHA, and USDA, right? But those are all primary, and conventional could be second home. That is not for a spec home. which is an investor building a home to sell for a profit. That is what the ground up construction program is for. In the ground up construction program, you can already own the parcel of land, which would then be considered a refinance because you have the land, you are putting the land as part of your equity into the deal, and then the lender will encumber your land, and then you build a home, and then you sell it, and you pay them off, right? The examples that I have here are would be more for the person that does not have the land and wants to buy the land along with get the rehab uh, costs as much as they can financed, right? So that's the dream, right? You see the piece of land, you buy it, and you build a home. Now, what I will state with this though is that you need to have plans in place already, right? Those plans need to be approved because you don't want to go through a plan approval process that's going to take 6 to 12 months, and in some cases even more, and eat up most of your construction time, because typically these loans are going to be 12, 18, maximum 24 months, depending on the experience level of the borrower, because the longer they extend the time out, the greater the risk, right, that it may not be built. So
So it must be vertical ready in these examples.
pretty much, yeah, you got to have those plans approved. You got to already have a builder, a contractor. Now, ground up construction, contrary to one time close, does allow the investor to also be the contractor if they can provide the necessary credentials and experience. So that is a plus right there. Not all the options do, but most of them would allow. They may charge you a little bit more in the rate, but they do, in most cases, offer that option, which one-time close does not. But just to state, you do have to have a contractor already in place with the credentials to be approved. You know, they got to have their liability insurance, they got to have their workman's comp insurance, they have to have their credit lines, they have to have references, track record. There's a number of things that the contractor needs to provide in order for the loan to be approved. So it's not just like, hey, I want to get that piece of land, let me buy it, and then let me get on the mission to put all of these items in place. You know, you do have to do some planning before you apply for the loan, right? You have to know what you're doing.
So they consider this the horizontal part needs to be done, right? All the
Yeah.
planning of the plan part, getting the land ready, needs to be ready to go vertical, meaning ready to put cement on the ground, put nails and boards, and start building up, right?
Yeah, you got to have your entitlements in place. Definitely. You don't want to get that raw land that's not even entitled yet to for utilities or anything like that, and then embark on that mission, which could take a while, right? That's why sometimes what people need to do is they would need to buy that type of land with some type of a land loan, bridge loan type option, short-term financing, get their entitlements in place, and then get the ground up construction loan as refi, right? You refi and get the construction costs, rehab, whatever you want to call it. So I'm going to share with you 3 examples today. And the main thing that I'm going to be focusing on is experience level of the borrower, right? In this scenario here, we have $150,000 lot purchase, $275,000 in construction costs, and a nice profit margin here. We have an ARV of $700,000. So this developer is doing a very good job of managing his project. Hopefully, not going to have any cost overruns. There is a 10% contingency reserve that's built into this loan. And also in this case, I have an 18-month term, which you do have an interest reserve as well, right? All of that is built into the loan. So this example here, first I'll go into the rate and then I'll go up into those numbers in a minute. Rate we're looking at for our one unit experience developer is 11.82%. This is an interest only payment, but remember, there's no payment because the interest is built into the loan, right? So in this case here, since the borrower only has one unit experience, the initial advance, that's what they're giving you at the moment that you close on the land, right? The initial advance is $56,794, right? And 84 cents. So whatever, roughly $57,000 of the $150,000 of the land purchase, right? So you're coming up with some money there, which I'll show you in a minute. And the loan amount is $331,794. So they're financing 100% of the rehab, which is the important part to note here. But the borrower has to come up with the difference at closing between the $56,000 and the $150,000 cost of the land, plus some other expenses, which I'll show you right here in a minute. Now, this doesn't include all the closing costs, but most of the general ones. But if you're looking at the 10% contingency, that's what they call liquidity check. That's actually the contingency reserve of $335,000. The borrower needs to come in with $146,541 liquidity reserves. Now that's what they have to show as available that they have to do the transaction. But again, at closing of the lot, $56,794, right? And so that's a pretty good deal considering one unit experience. Now, our 5-unit experience investor. Now, and by the way, this is for a 5-unit. This is not for a single family. So I'm here getting our investor that wants to totally take advantage of the great rents and everything, and he wants to have a good project. There's a lot of investors out there that are looking for small multifamilies. They're very difficult to find, a lot of demand for them. So this person says, I'm going to build a 5-unit, and he's going to sell that right away. Or they may decide to keep it as their own investment. You do have that option to refinance the construction loan at the end and hold it, which is very popular now. We're seeing a lot of that going on with real estate developers, with big condo developments that they were previously putting for sale. Now they're keeping them as investment properties because they're renting so well. So in this case here, our 5-unit investor, you see now that the initial advance increases to $68,615.16, right? Our total loan amount increases to $343,615. So we do have a good benefit there. The rate also drops from 11.82 to 11.06%. So we do see a benefit there. Now there is a cost in this product, 3.75 total points. That's the total between the lender fees, the broker fees, and all the origination fees on the loan. And then in our last example here, it would be a best case scenario, right? This is the person that, does this all the time. And by the way, when we're talking about units experience here, we're talking about in the last 3 years, not in their life that they've been doing this, right? This would be somebody that's really turning over a lot of properties. And when we're talking about experience level here, it's very important to note also that this does not mean homes that they have built as a contractor, right? This means properties that they have been the owner of the project from the inception, when it was the land was purchased, to the construction, to the exit from the project, the sale. They want to see the full cycle. So this person has been involved either as a partner or as the only participant in at least 10 ground up construction projects in the last 3 years. So this person's been very busy. So you see now the initial advance very high, right? Remember, it's $150,000 lot purchase. They're giving there $90,263.59 at closing. So at closing, they got to come up with the difference as between that and 150,000 as the down payment, closing costs, interest reserves, and you get the deal. Loan amount of 365 263.59. So you do see the benefit when you have more experience. But again, we have options for all experience levels. But in ground up construction, there really is no experience level option because it is so risky. So what we usually advise our investors that are looking to do their first project is to do it as a joint venture with somebody that does have unit experience under their belt, and split the deal 50-50, however you got to do it, and but you get the benefit of their experience level. So at that point, you probably would want to find somebody that has at least 5 units under their belt. You join them, and then you get the first one under your belt, and then the next one, if you choose to, you can do on your own and get 100% of the profit.
That was one of the questions we had here, but I think you answered it pretty straightforward there. But how else can they get experience? I guess, Jose, would be the other part of this question. Does fix and flip experience count?
Well,
they don't need ground up necessarily.
Right. Now that varies from conduit to conduit, right? So there are some options out there that if you have heavy rehab experience, like you did, I think it's like $100,000. I can't remember the exact threshold.
Or half. Now. It's 50% if the budget was over 50% of the total. If the rehab budget was over 50% of the total project, then it's a major. That's the cutoff there.
Yep. Then that would be considered as an experience unit experience to be counted for ground up construction. They really want to make sure that you can handle all of the rigors that are going to be involved and still be able to successfully exit the project. Because a lot of the issues you could have with cost overruns, mismanagement of the budget, miscalculation of what it was going to cost you to build, not handling your subs properly. I mean, a whole number of things that can happen aside from the usual maybe supply side issues causing increases in your materials. I mean, a lot of people are suffering from that, whether they have 20 unit experience or not. But it's a lot of the other things that can happen that would cause you to mismanage the project, and in the end, run out of money, have a 75-80% finished project that now the lender may have to look at foreclosing on it, and then it's pretty tough to sell a project that is not complete.
Bad for everyone, right? So let's just, I guess, I would like to just walk through this real quick. So the advice to our team here would be, if your investor doesn't have any experience, how do you get them to there? So the correct answer to there, Jose, would be they would do a regular flip, not a major, right? They can't get approved as a first-time investor. So this would be for someone that wants to do it all under their own belt, as Jose said, right? If you don't want to add somebody else in your deals, you're going to have to start small with a small flip. And then once you have a couple small flips, you can get approved for a major flip, as Jose explained, with over 50% of the budget. Usually once you have 3 regular flips, you can get approved for a major flip. So then your next 2 would be majors. Then you would have 3 regulars, 2 majors. Then you would qualify for the programs that Jose just explained. on your own, as long as that conduit allows it and your credit allows it and all that kind of great stuff. So that would be how you get the experience from zero to ground up. There's no way to just come in fresh off, this is my first project, I want to build a ground up, unless you bring in someone who knows how to build ground up or has the 3 minors and 2 majors that would probably get you in the door. So that would be the picture that I would paint to you there, Richard, to get your customer from nothing to prepared. But remember, that's going to take probably 3, 4, 5 years, even if you were foot on the gas the whole time, right, Jose?
Absolutely. I always like to say 100% of nothing is nothing, you know. So, I mean, if the person really has a good idea and wants to take advantage of an opportunity, it's not a bad idea to bring in somebody, especially if you have limited experience doing it, that you're going to be learning while earning, and it's only fair to share the profit with somebody that's going to help accelerate your growth into the business. And then the next one could be 12 months down the road to 18 months down the road. If you finish this one fast, just finish it faster and you will get a jump start on your business.
Exactly. That's what Jose said. So you have an idea, you either wait 5 years to get there, to do it yourself, to get the 5 experiences that you need, or you partner with someone and you get the experience today. And then, like Jose said, you do it quick. The next one's all you, right? So you got to bite the bullet at some point, right? It's either going to take the long, slow 5 years really to get that experience, or you partner with someone that knows what they're doing. And the lenders aren't dumb. They do that for a reason, because it's good for you, right? It's good for, your investor there to have someone with experience.
All right. I think we can go ahead and wrap it up then. Appreciate everybody tuning in. Great info there, Jose. Remember, we do this show 11 a.m. Eastern every weekday, where we go through live rates and then do a different topic for a deep dive. So we'll be right back here on Monday, 11 a.m. Eastern, for a new topic. So we appreciate everybody tuning in. Thank you, Nick. Thank you, Jose. And we'll see you all on Monday, 11 a.m. Eastern, for the next episode of Daily Rates Live with the Mortgage Calculator. Have a great weekend, everyone.
Thanks, everybody.
Thank you, everybody.